Good morning and welcome everyone to Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, Indian equities are poised to open higher following global rebound. US stocks ended higher as investors shake off pressures driven by the deadly Israel-Hamas conflict. GIFT Nifty indicates a positive start coming in for the Dalal Street, and Asian stocks at this point of time have been on the upper side along with the treasuries on the rate optimism. FIIs, they continue to sell. They've offloaded equities to an extent of less than 1,000 crores, and DIIs on the other side have purchased equities, have lapped up and stepped up into the situation by purchasing equities to an amount of around 2,661 crore. Well, also if you talk about the FII trend, how is that shaping up overall for FNOQs? Well, FII continue to be net sellers for index futures, for index options, stock futures, Bank Nifty futures and also Bank Nifty options. So they continue to be sellers across the board when it comes to the Bank Nifty futures and the options put together. FNO ban, new in ban, what comes new in the ban are a couple of things. L&T Finance Holding, that's one, and MCX, no price for getting there. It has been on a sharp uptrend for a couple of sessions out there. Still in ban is Delta Corp and Manappuram, along with Indiabull Housing Finance and PNB are some of the other names there. Apart from that, also let's look at the option Qs. The Nifty PCR is coming at 1.04 versus 1.12. But it seems to be about that level of 1, seems to be a bit still in the overbought territory, but that remains to be seen if we cover more ground following the global recovery that we've seen across the board in the morning. Talk about the US shares, talk about the Asian shares. Well, we have seen some amount of recovery. Clearly, the entire sentiment relating to conflict has shaken off. I mean, some pressures have ebbed, but the conflict still remains. There are people who are still dying around there, and that's not a very pretty sight that we're looking at. So geopolitical concerns continue to weigh down on the sentiment, but also do bear in mind the fact that we are headed towards earnings season. Tomorrow, it's the IT major which will be coming up for the earnings, TCS, along with that buyback plan that it has announced. No other IT companies per se are looking to, are looking at buyback because they've already done. Two of them have done their buybacks, and most of them around that are very, very iffy when it comes to the buyback trend overall. But that's that. There is also a big downgrade which has come in financials from banks for NBFCs put together from HSBC. And this is a bit of concern coming in ahead of the street, ahead of the Q1 earnings. That is the one that you need to watch out for. Financials don't look pretty, and do also bear in mind the fact that PSU Banks took a sharp hit in previous session, 3.5%, close to 3% cuts, severe cuts which were witnessed in PSU Banks. Remains to be seen if we can see some amount of recovery perhaps which will creep into financials in today's session that could broadly be responsible for the recovery, if at all it enters to the Indian equity markets, just in line to what you've seen across the globe. Oil prices have been shaping higher, but it has a cascading impact on the themes related to oil. We're going to be talking about that in just a bit, but let's first discuss the trade setup strategies for the day, along with stock recommendation from Ruchit Jain, who is the lead research analyst at 5 Paisa, joining us this morning. Good morning there. All right, Ruchit, your strategy for the day for Nifty along with Bank Nifty, and also what kind of levels can one look at for financials, something in the like of HDFC Bank perhaps. How are the charts looking like?
Yeah, hi, very good morning. Firstly, thank you very much for inviting me to the show today.
Pleasure.
If you see the markets last few days, we have been witnessing some volatility on both the sides. Well, initially, although we had that war-related news in this weekend, but our markets have already been in a corrective phase since last 2 weeks. The second half of the September series, we witnessed quite a lot of short formations by the FIIs. Shorts were rolled over by them to the start of the October series, and if you look at the long-short ratio, then about 73% of their positions in the index futures are still on the short side. So there are no signs of short covering as of now. So I think markets will continue to take cues from this, from the global news flows, and stay within a broad range of 19,500, 450 on the lower side, and 19,700 to 750 on the higher side. If we look at the options data, yesterday 19,500 put option witnessed significant rise in open interest, and the highest open interest is now at 19,500 put for this weekly expiry. So generally, wherever you see high open interest in put options, that is considered as a support. So 19,500, 19,450 would be the support range to watch out for today. Till this is intact, we don't expect major crackdown from current levels, but rather a range bound session could be seen, where a pullback move, since the global markets are positive, a pullback move towards 19,600, 650 could be seen in intraday. So one should be very stock specific as far as intraday or short term trading is concerned. Banking space has relatively been showing underperformance. So I think till we see any kinds of shortcomings from the FIIs, this relative underperformance to Nifty could continue within the banking space. Although 43,800 would be the major support to watch out for today, and 44,400 to 500 would be the range where some pullback move could be seen. But what we are witnessing that the relative outperformance in Nifty is mainly because of the IT space. So IT has been doing well, especially the large cap IT names such as Infosys, TCS, HCL Tech. They all have recently witnessed a good price volume action. So I think IT space would continue to outperform. So even my picks are from the IT space itself. TCS is my first trading pick today, where we are advising to create long positions, ideally because of high top, high bottom structure. After that buyback news, possible of buyback news, we have also seen a renewed buying interest in the stock. So one can go long on TCS with stop loss below 3,580, expecting near-term targets around 3,760. And within this IT heavyweight basket itself, HCL Tech is another name where technically charts are looking quite promising. Last month we witnessed a good up move after a breakout from previous all-time highs. Prices have retraced, and what we have seen that the price up moves have been supported by good volumes, whereas corrections are now gone back of low volumes. So I think this is a very good structure from mid to long term. So one can go long on HCL Tech as well with stop loss below 1,220 for potential targets around 1,300 in next few trading sessions.
All right, I'm going to get back to you and check with you for Adani Ports. Perhaps the stock fell as much as 5% on Monday after the Israel-Hamas war was apparently, the report suggested, has affected the operation at Haifa port, in which Adani owns around 70%. Most of the brokerages, Motilal, for instance, has initiated a buy rating, and you have buying opportunity as a tag which is coming from CLSA. But we need to see how that stock reacts, and perhaps could be the stock of the day. But we have a couple more that we're going to be talking enough and more about once we address the market opening for you. We are looking at a positive start coming in for the markets. It is below that 19,600 mark. Let's just say it's floating around that 19,600 mark, but remains to be seen if we see more recovery through the course of the day for the markets to inch closer to that 19,600 level. Right now, the stock is up and about with gains to an extent of 0.5% out there. Let's also talk about Bank Nifty Index. How is that stacking up for you? Just to see if we're seeing some amount of broad recovery. And after that, we'd also like to see PSU Banks. 0.5% of gains coming in for the Nifty Bank Index to 44,000 mark, way above that level, comfortably around that level. In fact, it's inched higher to 44,100 mark. It is a good start coming in for the markets, in line with what the anticipation was. PSU Banks, well, we are looking at gains to an extent of more than 1%. That's where the relief is coming from, right? After the 3% drubbing that we saw in the previous session, finally, we've seen recovery coming in for PSU Banks. A couple of rejig at the top management for a couple of PSU Banks there, perhaps also aiding the sentiment for the PSU Banks overall. But also, let's look at mid-cap and the small-cap index. How is that stacking up? Mid-cap index gains to an extent of 0.75% for the mid-cap basket. A bit of outperformance coming through for the mid-cap index, and the small-cap also participating into the optimism. Gains to an extent of more than, or let's just say close to 1% for the small cap index. Let's actually look at the trend which is now playing out for the sectoral indices, something in the like of IT, which has perhaps been the outperformer, just like Ruchit was mentioning some time back. 0.25% of gains coming in for the IT basket. We need to see how TCS has been faring just ahead of the earnings, but Nifty Pharma right now looks pretty too. No, actually it is a positive, a flat start with positive bias for the pharma index. Let's look at FMCG, which again is a sector from the defensive space. 0.25% of gains clocked in for that one. Also, let's look at rate sensitives now. Also 0.75%, more than that, 0.8% of gains coming in for the metal basket overall. There is a Fitch rating which is coming through for Tata Steel, which is apparently doing well for across Feroze sector needs to be seen. Auto is in top gear. We're seeing gains to an extent of 0.75% for the auto basket. And also let's look at the other sectoral indices, something in the like of perhaps Realty Index, which is doing well in trade, 0.75% roughly. More than 0.5% of gains coming in for the Realty Index right now in early deals. Let's also look at the top gainers and the top losers that we have on the screen, just to see where the momentum is stacking up. Adani Ports, we spoke about it. That is the stock of the day, and perhaps just there on the list, Adani Ports is the one that you need to look at. Along with that, ONGC and Hero MotoCorp. These are some of the top gainers that we have on the list. Along with that, we have Tata Motors, Bajaj Finance and Tata Steel. These are some of the top gainers that we have in the list on this morning. Adani Enterprises, M&M and Bajaj Finserv. No surprise for getting there after a bit of drubbing that has come in for the Adani group of companies in previous session trade after the whole conflict essentially weighed on the sentiment. A bit of recovery. Motilal initiates a buy report, and you have CLSA asking for the company for perhaps adding on to the stock on every dips. That's the word coming in for Adani Ports, and Adani Enterprises also reacting well to that. Well, also let's look at the top losers that we have on screen just to see how the momentum has been faring. Well, DRL, we're going to be talking about it shortly. Britannia, TCS, which is one of the top losers ahead of the earnings. Britannia also is down and out in trade today. Let's also look at some of the other top losers that we have on the screen just to see how the momentum has been stacking up. Cipla, Asian Paints and HUL. Well, a bit of mixed trend coming in for HUL, but pharma stocks are the one which are perhaps not faring well in trade. Do bear in mind the fact that pharma stocks perhaps could be a bit of outperformance coming in this quarter, because a strong quarter is expected for overall pharma category put together. We're going to be talking about GRL and the development related to that. Let's actually address the entire stocks and news that we have. We've already spoken about the Adani Ports. Let's also talk about Dr. Reddy's Lab, which is named among defendants in a complaint filed by Mayo Clinic and LifePoint Corporate. Now, the complaint has been filed in the US District Court, Northern District of California, and it alleges that the company has restrained the competition. It alleges that company has maintained a share monopoly in Revlimid generic that, overall it's challenged the agreements improperly. It's delayed the generic entry entirely of the segment put together until 2022. So that's the word coming in. Now, Elara Securities has come up with a report on this development and has spoken about, had said that typically these litigation drag on for years. This is before getting settled for amounts which are often 20 to 40% of the profits. No agreement on pricing and settlement, only deals with volume help pharma companies. And Dr. Reddy has about 50% of the profit from Revlimid generic. So that's one of a negative development which is way down on the sentiment of Dr. Reddy Lab, perhaps which is one of the top losers on the index. Sun Pharma, Cipla, Zydus Life also, there is a Revlimid generic which is around 15 to 25% of the overall profit. So I wouldn't be surprised to understand if even Sun Pharma and Zydus Life, along with that of Dr. Reddy's, have actually taken a bit of selling pressure at the moment. Tata Steel, where Fitch has upgraded in the rating for Tata Steel to BBB. Outlook has been kept at stable. Fitch has also upgraded the rating of Tata Steel subsidiary ABJA investment company to BBB minus from BB plus. Now, Fitch is expecting an improvement of £150 to £170 per ton in the cost basis when it comes to the UK operation following the capacity transformation, which is significantly higher than the unit loss that this particular unit had taken in FY23. Fitch also expects an improvement of around 150 to 170 overall in the capacity transformation that we've just highlighted and spoken about. What I also wanted to talk about was financials. There is a downgrade report which has come in by HSBC, and it has downgraded SBI Cards to hold from buy. The target price has been cut to around 860 per share from 990 per share earlier. It's cut also the EPS target on sticky revolver base. It's also spoken about prolonged margin pressure and continued uncertainty in asset quality, thereby valuing SBI Cards at a 1-year forward book to price value of around 5.4 times. It's also downgraded LIC Housing Finance, and the target price has been slashed lower to 400 rupees per share from 380 per share earlier. It's raised in the EPS target by around 5.8 to 15.3% from FY24 to 26. It's maintained the target multiple at around 0.6 times 1-year forward price to book value per share. It's also downgraded Bank of Baroda to hold from buy. There is a rating change which is coming. The target price has been revised. There is a downgrade from Ujjivan to hold from buy. The target has been revised actually higher to 620 per share. It speaks about expensive valuation, few re-rating triggers for this particular stock, and the peaking earnings which are likely to weigh down on the stock return profile of the company. Well, right now the stocks seem to be doing well, but we will not be surprised to see some amount of negative sentiment prevailing for these companies after the earning, because there is a bit of NIM compression that has already been witnessed in the banking sector. Whether will that be further magnified in the quarter, that's yet to be seen. Sakshi, Medtech and Panels, that's the new one where ace investor Ashish Kacholia perhaps has bought in more than 6.2 lakh equity shares. These have been bought at an open market transaction at an average price of around 167 per share, amounting the total deal to an extent of 10 odd crore. That's the word coming in for this new stock that you need to keep on list. But we're going to go back to our technical guest and check with him what does he make out of something like an Adani Ports and Tata Steel put together.
Well, yesterday, if you see, then Adani Ports witnessed that correction due to news flows. But the crucial support of 89 is exponential moving average is still, which is placed around 780. So until we see a breakdown below 780, as downside seems to be limited here on, we could see some pullback move back towards yesterday's gap area of 830, 835. So some pullback move should be expected in Adani Ports. I think metal space overall, if we talk about Tata Steel, then we have seen a good move in the dollar index off late. And usually there is inverse correlation between dollar index and the metals. So whenever we see up move in dollar index, there is a relative underperformance or some corrective phases in metal names. So I think in short term, until we see any kind of downtrend resuming in the dollar index, we could see relative underperformance or a consolidation from the entire metal basket. So Tata Steel, although longer term trend is positive, but in short term, I think the stock should see either some consolidation or some more price-wise correction. Major support for the stock is coming around 120. So if we get any kind of dip towards that 120 levels, then one can look for buying opportunities over there.
All right, Ruchit, last question that I have for you perhaps is more about the oil producers, Oil India and ONGC perhaps were the top gainers and perhaps the beneficiary of the crude oil prices which have been on uptick. How do the charts look for these companies?
The charts are quite positive. Oil India primarily have been rising along with the higher volume, so the structure is quite good. So if any existing positions are there, they can continue to hold on with stop loss below 295 now. And ONGC, the stock is trading around this 40 EMS support. 180 is a crucial support for the stock. So if till 180 is intact, even the trend here looks promising. So one can take fresh long positions as well in ONGC with a 6 stop loss below 179 for potential pullback move targets towards 190.
All right, Ruchit, we're going to leave it at that. And thank you for taking out the time and speaking to us this morning. All right, that's part of the show where we address the fundamental side of the story ahead of the earnings season and also a couple of now geopolitical concerns. How does the portfolio need to be shaped up, whether there are changes that need to be done in the first place? We're being joined by Feroze Azeez, Deputy CEO of Anand Rathi Wealth early in the morning. Morning there.
Good morning, Nickey.
Right, how are you doing? Just wanted to understand, we're headed straight into the earnings season. TCS will be reporting in the numbers tomorrow, but there is a bit of concern, geopolitical concerns, which are just at the surface. Perhaps at this point of time, what are you suggesting in terms of allocation for the entire community put together, just the retail community that I'm talking about? Do you think they should actually now start looking at the large cap names as compared to that of mid caps?
Nickey, I would say that we are still a little early to say that, because if you compute, we have a method in which we can compute what kind of inflows small cap funds would give in September. Of course, AMFI has not released the official data, but I'll tell you that the estimate is 2,000 crores came into small cap. Small cap as a universe is a low free float several times, and when you look at the index top 10 stocks like Suzlon, KPIT, and all these, there is reasonable amount of inflow which is coming in. So price re-rating, like has happened in the large cap, because index fund investing. I think index fund investing in the small cap stock is also picking momentum. So there is going to be liquidity, which will drive these valuations and the re-ratings. Point one, 2,000 crores of September inflow, which is, of course, half of what has happened in August. Of course, the 2,000 crore number is my estimate as Anand Rathi Wealth Limited. It could be marginally up or down. Is still seeing liquidity. So as long as there's a paradigm shift in the way Indians are investing, household savings have been reasonably robust. Small caps will have re-ratings. Point 3, point 4, if you look at the earnings estimate, I think earnings estimates will catch up. Analysts have not been able to predict earning estimates on the small cap sides reasonably well. 16 out of the 17 quarters, the estimate has gone wrong by about 3 to 4%. But I think that the earnings will catch up. Point 4. So I would say that we are a little early in the game to move from small cap to large cap. We moved in the first of financial year. We increased our small cap exposure from 5-6% to 30%. And of course, there's been about 20% outperformance, 20-25% outperformance of the small cap index. We think we will not want to miss the last lap of the rally. As we get into the next calendar year, I think elections will take center stage, and there could be some degree of risk aversion, which can mean flight of capital.
Sure. I also wanted to chat with you related to the themes which essentially relate to your crude oil prices, because that's the one which is perhaps feeling a little more heat out there, and is seen perhaps is holding in the biggest gain in nearly 6 months on the Middle East tensions. So how are you looking at it, from a very equity standpoint of view? Because the positive correlation between oil and equity markets now will be disturbed with the geopolitical concerns which have set in. That's number one. What's your assessment about it? And also in terms of themes, something like for oil producers, something in the like of paints, something in the like of oil marketing companies. How are you looking at the entire, crude derivative related themes?
Yes, Nickey, you're absolutely right. From a sentiment standpoint, this becomes a very important variable. But if you break down our $205 billion of oil imports last financial year, 16.7 came from Russia, 16.6 from Iraq, and if you look at the UAE and Saudi, contribute another 30%. So our 60% of $205 billion of oil import come from this country. Qatar is about 6-7%. Iran already has an embargo. So from an oil standpoint, I don't think it will have a significant material impact financially, but sentiments definitely are very, very critical. I think that's why you see some degree of buoyancy in the equity markets in spite of what happened over the weekend. And if you look at what we get from Israel is less than 1%. So I don't think it'll impact materially, because the other very, very overwhelming variables from an Indian standpoint, which will dictate the markets and its liquidity. If you look at the FII flow, has been negative for about $1 billion for the first few days of this year, of this month. And last month, you saw about 14,000 crores going out. Domestic inflow was 20,000 crores. I think liquidity will drive the market. Still, elections become the key focal point of the direction of the market, and crude, I think, will be behind us. Of course, this time around, the unsettlement is calling for countries taking sides, which could have implications, but I think we have to keep an eye on it. But I don't see a large concern from an equity market and its correction, because we are already down about 3-4% from the 11th of September levels, which was driven by FII flow.
All right, Feroze, I also wanted to chat. You spoke about FIIs just now. The trend has been negative after a matter of 6-7 months odd for equity markets. Maybe one could just look at aberrations of sorts coming in for the FII trend. I wanted to understand from you if treasury yields, if they were rising for that matter, do you think the trend further going to that direction, FIIs could be more of net sellers, and by virtue of that, you would see further sell down coming in the financials name? There's a downgrade report which has already come in by HSBC. You think that will probably weigh down the markets further?
I don't think so, Nickey. Of course, there could be 4, 5, 7% corrections in the equity market for an investor is the part of the game. If you're trying to predict trends which are going to be accentuated and larger falls, I don't think this could be the reason of a larger fall. From financial services standpoint, Nifty, 33% of Nifty is financial services, and there's so much index fund investing happening that these 33% will get impetus from the liquidity. Point one. Point two, of course, the negative report could result in about 3, 4, 5% kind of corrections, but I think as an investor, I don't bog myself down with any variable which does not materially impact. The long-term average fall from peak to trough in Nifty is about 14.3%, even if you exclude 2008 and 2020. 14% is the average fall from peak to trough. Now, this year, you look at the average rise is about 19.3% from the March lows till the peaks of 20,160 odd. We've seen a 19% rise. So a 10% fall is not something which an investor should materially change his portfolio. So coming back to your point, I think FIIs were net positive for the first 6 months after a long period of time. If you look at the US Treasury yields reaching 17-year highs, of course, there's going to be some degree of fight of capital, but there is going to be sanity which will prevail because RBI stance on liquidity will become neutral, is our estimate. If that happens, relatively, Indian equities will be more attractive given the global sentiment on interest rates and the yields, 17-year high yields, and India is not at the highest yields it has achieved. So I think relative attractiveness will bring back FIIs. But having said which, like you rightly pointed out, Nickey, a 4-5% correction is very, very healthy. From an investor standpoint, traders generally have stop losses. Investors don't have stop losses. If they reverse their position, traders reverse it. Investors don't reverse it. So it's very, very dangerous for an investor to stay out because he does not book his losses and come back in with 2% moves. He's out of the market for 20%, which is a very, very scary thing. If you try and time 5 times in 10 years, you will have one such instance where you stayed out for 20-25% rally. So that's why I'm not too worried from an investor standpoint. From a trader standpoint, I couldn't concur with you anymore.
Sure. I'm just going to focus more towards the sectoral themes right now ahead of the earnings season. What are you looking at, Feroze? Essentially, are you looking more at the bank side? Are you looking more towards the IT side or the pharma? Which are the sectors essentially which stand out for you and why? And the top bets within that space?
Nickey, I think one thing from a larger theme perspective, there's a shift in the way Indians are spending. So I think spending towards services is going up. So all the service sector industry, healthcare, transport, education, entertainment, all these will get some impetus because of the paradigm shift in the way India is spending. And India, when it starts spending, it's a big elephant. And if it goes in a certain direction over long periods of time, structurally, there could be volume growth for these industries. And in turn, the margin growth could be a little concerned. But I think over a period of the next 4-5 years, this is one theme one should definitely play out in a portfolio because there is a shift in the spending pattern. And that's the green shoots of that are very, very evident.
All right. Would you also be looking at, since you have spoken export driven, but specifically if we are talking about IT, you spoke about pharma essentially too, apart from other names which have come through. Within the IT basket, what do you like? Do you like something in the like of TCS, which is perhaps going to be giving in details of the buyback plan much awaited by the markets? Do you think the outperformance which has mainly come in the markets recently because of the IT shares, the weakness perhaps could be shrugged off in this quarter? You think they are attractive bets?
Nickey, I think buybacks are a great way from a tax-efficient payback standpoint to the promoter and all the shareholders. So if you look at the behavioral pattern of a stock after buyback, especially TCS, you would not be very excited about point one. And I would say that in the IT space, I would look at the mid-size IT companies, which have you have to cherry pick because there's some degree of valuation concern there. But I think there is still opportunity available. IT as a sector has gone through a rough patch over the last 1 year. Of course, the bottoming out from the last quarter was called out by us, especially because the bad results also resulted in a reasonable move for the IT as an index. So to answer your pointed question, mid-size IT companies, cherry-picked, is what we still believe has a lot of value to be made because I think the European discretionary spending on the IT side will improve significantly from the sluggishness it has shown for the last year and a quarter.
Sure, Feroze. I'd also want to chat with you about PSU Banks. There was a bit of drubbing which came through in the previous session. Perhaps you might just call it a healthy correction which has come in for these stocks, and a bit of recovery that has followed suit today. Do you think at this point of time, how are you comparing the private banks versus that of PSU banks, which look more attractive, and within the category, what do you like?
You see, PSU banks were always categorized as value stocks. If you look at the funds which are driven by the principle of value, are now in a dilemma whether these remain value stocks or not. Do they remain dividend yield stocks or not? So there is going to be some degree of outflow from the domestic institutional players because the mandate they've been receiving is value and dividend. Now, if the stock in the value index, we create a value index and a growth index. The value index is the one where you can say these are the 500 companies out of which this subset is value, this subset is growth, some large set is neither of these. So these PSU rallies has thrown out some of the stocks outside the value index, or the dividend yield is no more attractive. So there is going to be domestic institutional selling which will come because the mandate was dividend yield. So I think that's one headwind which you will see in these stocks. But otherwise, these stocks are relatively more attractive from the banking, private sector banking space.
All right, Feroze, we're just going to leave it at that. And thank you so much for taking out the time and speaking to us this morning. All right, with this, it's a wrap and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of the screen. And for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.